The Palantir stock has been the topic of many conversations as of late, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Palantir is currently having a bit of pullback from the previous recoveries after touching the bottom in early May. I would say that the current stock performance of the company is something that the market has already priced in since the early 2022, because it was clear that the market has entered into a new phase with the instabilities in the world, the slowdown of emerging markets, and the significant increase of inflation, which is usually coupled with an increase of the central bank interest rates. All these have created an environment where the capital is not only risk-averse, but it also has a place to park its money into, much like the tech sector back in 2020. Meanwhile, Palantir on a fundamental level has been progressing on its own pace, which can be seen as encouraging under more favorable market terms. But at the moment, they are not necessarily the critical factors that influence the stock performance. Essentially, they have been priced in by investors as a likely scenario. The announcement that Palantir will be working with some of the world's largest companies is certainly something that has been clearly in the mind of most stakeholders since the very beginning. On the other hand, the recent uptick in the VIX number may have taken people by surprise, which probably had a far larger echo in the market, including on Palantir. Now, let's also take a look at Palantir's technicals. The trading volume of Palantir has recently been 25 million shares versus an average volume of 34 million shares. Over the previous 52-week period, its price fluctuated between $6.44 and $29.30. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and momentum about the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current level is lower than the average, it's an interesting indication nonetheless, because this may signify that a trend reversal may happen soon. The market cap of Palantir is currently $16 billion, compared to the enterprise value of $26 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company that it has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for many growth companies may be the intangibles, meaning that they're not items, inventory, or equipments that a company can use, but they're secondary items which promise that a company can grow significantly in the future, such as the existence of charismatic CEOs and management, blueprints for new products, and pledges for major contracts. Most of these valuations, as far as the startups are concerned, have been based on the intangible, which may have been valued in much more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, but it doesn't mean that a company itself may be necessarily undervalued. It's also possible that a company was overvalued in the first place, and it's now deflating back to the reality. As we compare the current price to the historical price fluctuations, the stock is 9% higher than the 1-month low, 25% higher than the 3-month low, and 25% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 75% versus a historical volatility of 110%. The put-call volume ratio is currently 0.63. And it is normal for many stocks to also tend to have a higher put option volume than what they truly deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 56,000 contracts a day versus the 30-day average of 71,000. The most recent open interest volume has been 3.1 million contracts versus the 30-day average of 3.2 million contracts. The option contract is a derivative from the underlying security, which gives participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there may be possible uptrends on a move, or that a reversal may happen if there's a lot of call options. The reasoning behind that theory is that most options contract would expire worthless. Regarding the shareholder structure, institutional owners have about 32% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of the company, as this helps to determine if you would hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there would be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great titles are mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this may be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is 6% of the total float, and 43% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out from the dark pools, this may suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. It's not the case for Palantir at the moment. My recommendation about Palantir is to adopt a dollar cost averaging approach, and then to determine if, in your opinions, Palantir has a future in the long term. I personally believe that this is going to be a long-term play, and that the upcoming 12 to 24 months are going to provide excellent opportunities to enter in a position at interesting price levels. I would recommend to commit between 5 to 8% in your portfolio on Palantir, and would also recommend to split the allocation in 10 to 20% at a time, so that you can purchase more of it if it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.